Hello, everybody. Thanks very much for joining us on the third installation of our 101 series for estate planning. I'm very happy to have two guests here with me today. Dominic Cazzetto, who is a financial advisor at Advice Period, and Stephen Wallace, who's a partner and attorney at Accelerant Law. Thank you both very much for being here.
Thanks for having us.
Thanks, Dan.
Yeah, absolutely. So today we're going to talk about advanced planning. We've talked in our last two courses about sort of the fundamentals of why you want to do estate planning, as well as some of the basic documents like powers of attorney and wills. And now we're going to get into, what you need to be thinking about for some of the high net worth and ultra high net worth clients you might have. So we'll talk about grantor versus non-grantor trusts, generation skipping tax, and common irrevocable trusts. Let's start with a background for advanced planning. What is it? Why do we need to think about it? Stephen, you want to kick us off, but I'd like your perspective on this as well, Dominic.
Yeah, of course. So I think we should really just start with the basic building blocks of the federal gift and estate tax system, right? And so every U.S. individual by birthright is given right now a $12.92 million exemption from estate and gift tax. That means if I had $11 million and I died today, I would pay no federal estate and gift tax at an all-time high right now. The important thing to remember is that this number is set to basically be cut in half starting on January 1st, 2026 by the statute. So unless Congress makes some step in the next couple of years, it's going to be cut in half starting on January 1st, 2026. Some of the other building blocks that you'll typically hear about are the annual exclusion gift, right? So an annual exclusion gift is you can give $17,000 to any person anywhere, and that does not use up any of that exemption I just discussed, the $12.92 million. So that's one of the basic building blocks. And then, some states, in addition to the federal government, impose an estate tax as well. So 13 states currently impose some level of estate tax ranging from, they all have exemptions, but the exemptions range from $1 million to matching the federal exemption. And then there's 6 states that also impose what they call a state inheritance tax. And so that's paid by the person who receives the bequest from you. And it's typically the tax rate there is based on the relationship between you and the donee. So in a lot of states, if I give assets directly to my child, there's going to be no inheritance tax. But if I give assets to my nephew, there will be some layer of inheritance tax. So that's kind of the basic building blocks there of when somebody's going to be subject to estate tax. And then, from my perspective, and usually from Dominic's perspective, is when we get a client's balance sheet who is hovering around that, either they're a single individual and they're around the $13 million number, or a married couple around the $26 million number, or they're going to get there at some point in the near future, depending on their age and their asset composition. Then you start thinking about, should we do some advanced planning for this person, right? And so what's the point of advanced planning? The point of advanced planning is to fully leverage the estate and gift tax exemption and the corresponding generation skipping transfer tax exemption to most effectively and efficiently move assets not only off the client's balance sheet, but the appreciation on those assets off of the client's balance sheet, hopefully in perpetuity, depending on where the kind of vehicle you create, the trust structure you create is sightest. So that's really the whole driver behind advanced planning, is to kind of move assets off your balance sheet and the future appreciation on those assets off your balance sheet so that they never enter the transfer tax system again.
Great. And so, Dominic, you have a lot of high net worth, ultra high net worth clients, and you're dealing with this on a day-to-day basis. What's your sort of approach when it comes to advanced planning? Maybe your philosophy as you look at clients and try to figure out their plan.
Sure. I think the number one goal when we have discussions about this is that you don't have to give it away to your kids directly. You don't have to give up control, and you don't have to give up flexibility with your planning. So oftentimes when we broach this subject with clients, like, I don't want to give all my money away to my kids right now. I'm not ready to do that. And we emphasize properly structured planning can give you that control, can give you some flexibility, and doesn't necessarily have to benefit your kids right away or during your life or your spouse's life. It can be for them ultimately just how you have it designed in your current estate plan, but we can ensure that, as Stephen mentioned, that those assets are moved out of the estate tax system. right now at a $12.92 million exemption, we have a lot of room to be able to make those gifts and to make sure that that happens. So it's really emphasizing to clients that you don't need to give up all your control. It doesn't mean that these assets are completely gone from your ability to be able to benefit from them as a married couple. It just means that you're really taking advantage of this great system, these great benefits that are in place right now as far as how large the estate tax exemption is.
Appreciate that perspective. That's great. So you mentioned the generation skipping tax, Stephen. What is it, and why should people be caring about it?
Yeah, so I would say, the generation skipping transfer tax is a separate tax from the estate and gift tax that I just mentioned. So what the government noticed was that people were trying to skip a layer of estate tax, right? And so instead of giving assets directly to their children, they noticed wealthy people were saying, I'm not going to give it to my kid, I'm giving it to my grandkid. And so I'm going to take it effectively, I'm going to remove one layer of estate tax that would have been imposed at my child's death when they own the assets, right? And so in order to mimic the additional layer of estate tax, they basically have said, if you give, based on your linear relationship, if you give an asset to a grandchild, that's subject potentially to the generation skipping transfer tax. And for non-related individuals, if you give an asset to somebody who's 37 and a half years younger than you, that is potentially subject to the generation skipping transfer tax. The government's really focused on making sure that there's the additional layer of tax at that intermediate generation, right? And so as an advisor, what you really want to think about is when you're focused on a client is what's the relationship between your client and the donee who's receiving the assets, right? Is it a grandchild? Because then you have potentially a GST issue. And then for an unrelated person, you want to think about what's the age difference between my client and the person receiving the asset. I'll just tell you a funny story about a client I have who is, much older. He's in his mid 90s now, and he wanted to make sure that he took care of his girlfriend. And so, without really thinking about it, I just assumed that his girlfriend was around his age, or maybe in her 70s or something along those lines. And it was the incorrect assumption by me, because the financial advisor who has a closer relationship with the client said, no, she's 40 years old, so she's a skip person. So when we were drafting the documents, we really had to think about how do we make sure that we can most effectively transfer the assets to her without kind of getting the generation skipping transfer tax imposed. And for that client, we had to make sure we leveraged his exemption from generation skipping transfer tax in the most effective way. So again, just going back to the close relationship between financial advisors and lawyers, they can kind of catch you in a blind spot there where you may not be, totally aware of the relationship between the client and somebody who's, important in their life.
Great point. Anything to add on this, Dominic?
I would just add that right now, the exemption amount that Stephen referred to is equal to your lifetime exclusion of the 12.9. It hasn't always been that case. So really, I think it's back to kind of taking action today, because when you think about the ability to have generation skipping tax exempt assets kind of go on forever and be excluded from the transfer tax system is really powerful. And for those financial advisors like to model things out over very long periods of time, you can just imagine what taking something out of being taxed every year at that, or every lifetime, I should say, at the 40% rate really does to asset growth over time. It really puts it in a supercharged way. So it's kind of just about back to opportunities for clients and ensuring that they're thinking about them the right way and not missing opportunities.
Great point. All right. So another sort of a foundational element here, grantor versus non-grantor trust. Can you talk a little bit about this, Stephen?
Yeah, of course. So, a grantor versus a non-grantor trust is an income tax concept. It's not an estate and gift tax concept. But whether a trust is grantor or non-grantor is entirely determined based on the powers that the client maintains over the trust. And so for a lot of clients and a lot of attorneys, when they're drafting a trust, an irrevocable trust during the client's lifetime, is they're going to create it to be a grantor trust during the client's lifetime. And that's because grantor trusts are the most powerful and dynamic trusts from an estate planning perspective during the client's lifetime. And some of the common powers or strings that a client retains over a trust that make it grantor are the power to substitute assets, or a swap power. So basically it's the power for the client to tell the trustee, I'm going to give you assets A that I own right now in return for assets B that are owned by the trust. They're of equivalent value, and I'm going to take those assets back. And so for a lot of clients, that can lead to great basis planning, but also cash flow. You can manipulate the client's cash flow if they need to during their lifetime. Also, the great thing about grantor trusts is that the client is deemed to be the owner of that trust for federal income tax purposes. And so what that means is the client has a legal obligation to pay those income taxes on the trust assets. So let's take a trust, for example, that had $10 million of income this year. If it's a grantor trust, that client is responsible to pick up 37 or 40% of the federal income tax on their individual income tax returns, meaning that the trust doesn't use its own assets to pay. So you just saved that trust $4 million of growth right there. You kept it in the corpus of the trust. One of the other things that's really powerful about grantor trusts from an estate planning perspective is that you can sell assets to the trust, and that's not a deemed recognition event for federal income tax purposes, because for federal income tax purposes, that grantor trust is your alter ego. So very flexible kind of trust to use during a person's lifetime. A non-grantor trust is just a trust that you create that you don't have any of those special powers over during your lifetime. And so basically what that means is that the trust is going to use its own corpus to pay its income taxes each year. So if you go back to my previous example, trust has $10 million worth of income during the year. The trust is going to have to use $4 million of that income to pay its income taxes during that year. So at the end of the day, the trust only really nets $6 million if it's a non-grantor trust, whereas if it's a grantor trust, it nets $10 million. And so just that ability to pay the income taxes on behalf of the trust leads to a supercharge of growth in the trust assets over a very short period of time. Some reason somebody might create a non-grantor trust just during their lifetime is for state income tax benefits. There's some states where they don't impose an income tax on a trust. So for example, Delaware, Nevada are common jurisdictions that don't do that. And so sometimes when people are trying to do a state income tax play, they might create and fund a trust with a Delaware or Nevada situs and a Delaware or Nevada trustee to kind of structure around some state income tax concerns that they may have. One other important thing to remember is that upon a client's death, a grantor trust automatically becomes non-grantor. So it's going to become its own taxpayer at that point in time.
Great. All right. Dominic, anything on this one?
Yeah, this is an extremely important topic for clients when they're starting to do advanced planning, because oftentimes I've heard this be an issue. They're like, well, wait, I don't want to pay the taxes for this trust. Like it's like they're getting more taxes than they otherwise might have to pay. So for the financial advisor to understand this concept is extremely important. So you can explain it to the client, no, this is actually a tax-free gift that you're actually making for the trust. And this gives you more flexibility over time to be able to exchange assets with the trust, with a grantor trust. There's been many times where we've had clients that might have a stock that they're holding in their personal portfolio that has a very low cost basis. So if they were to sell that, they would realize a large capital gain while there's cash sitting in their grantor trust. So as Stephen mentioned, you could do a substitution or an asset swap where you exchange that low basis stock for an equal value of cash. And all of a sudden now you've got the flexibility to pull cash in to be able to spend that without having the capital gain implications that would result from you selling it in your own estate. So very powerful tool. I think it's back to that flexibility point. And the other thing that we've used in the past is when this no longer becomes a solution that the client can really stand because maybe their own cash flow is very low, or they feel like it might overwhelmingly benefit one of their beneficiaries than another beneficiary. If there's different trusts, you can turn off this provision. So you can release those powers and then you no longer have to pay those income taxes. So helping the client understand that this really just gives them more flexibility over time. It isn't just a pure tax on them or something they have to pay going forward and doesn't benefit their overall picture is really not true. And so you've got to kind of educate them during that process.
Framing it as a tax-free gift is a really nice, simple way of approaching that. That's great. All right. Thank you. Let's talk through some common irrevocable trusts. Obviously, we won't be getting to all of them, as this says, common, but we'll also hopefully have a 201, 301 track as well, where we'll dive deeper into each one of these trusts. So we're just going to kind of give you an overview of how each of them works and the structure behind them. Stephen, you want to talk us through the grantor retained annuity trust?
Yeah, so a GRAT is, one of the basic like intro to advanced planning techniques, right? And so what a GRAT is really a transfer tax, or it's an appreciation vehicle, right? So it's the way to transfer appreciation from you to your children in the most tax efficient manner. So it's an irrevocable trust that's designed to transfer all the appreciation from yourself to the beneficiaries at very little gift tax cost. And it's because most GRATs are designed to be what they call zeroed out. So basically what the taxpayer is going to do is they're going to contribute assets to the GRAT, and in return for that, they're going to get an annuity for a term of years. And so the right to the annuity is equal to the approximate present value of the gift plus what we call the 75/20 rate, which is a monthly interest rate that the IRS publishes. And so anything in excess effectively of that 75/20 rate passes to your remainder beneficiaries transfer tax free. So let's say you create a GRAT, you fund it with assets worth X amount of dollars, and the 75/20 rate is 3%. Let's say at the during the 3-year GRAT annuity period, the assets grow at 6%. That 3% delta just passed to your remainder beneficiaries without using any of your estate or gift tax exemption. So it's a great vehicle to kind of transfer appreciation between you and the remainder beneficiaries. I think a couple of the key takeaways here are you're only going to transfer the appreciation, right? So you're not moving assets off of, a big chunk of assets usually off of your balance sheet because it's not using up really any of your exemption. They're almost always zeroed out for most taxpayers these days. And one of the important things to remember too is that the taxpayer has to survive the GRAT annuity term. So if they die during the annuity term, then all those assets get pulled back into their estate, and the GRAT effectively just failed. It did not work. I think one of the things to really remember here too when you're talking with a client is GRATs are great for transferring assets to your children. They're not great at transferring assets to your grandchildren. And we'll get more into that concept in a more advanced class, but it's because GRATs are subject to what they call the estate tax inclusion period, which basically means that you can't apply your generation skipping transfer tax exemption until the end of the GRAT period. So basically you're paying full freight with respect to your GST exemption. And so if let's say you're at the end of the GRAT, your assets are worth in the GRAT $2 million, you passed on to your remainder beneficiaries, that's going to use up $2 million of your GST exemption, even though you use none of your gift and estate tax exemption to make that gift. So those are some of the kind of key takeaways there.
You mentioned
thoughts on that?
Well, just one clarification point, and some folks will know what this is, but you mentioned a zeroed out GRAT. I think that's a Walton GRAT too. Is that right?
Yeah, of course.
Could you explain what that is? Yeah.
Yeah, definitely. So traditionally, a GRAT could not. The service took the position that the GRAT could not be zeroed out because there was a mortality factor implicit in valuing the taxpayer's retained annuity interest, right? So even for a 30-year-old, there's some mortality factor related to them creating a GRAT. And what the Walton case, which is a member of the Walmart family, Fortune, they created a zeroed out GRAT. And so now the service, and they lost the tax court case because what the taxpayer retained was the right to receive an annuity during their lifetime. And if they died during the lifetime, then the GRAT would be paid to their estate. And so you no longer had to factor in that mortality factor anymore. And so you could effectively zero out a GRAT at that point. And so the Walmart family took it to court, and they won, and they beat the IRS. And so you can now zero out a GRAT. It's called a Walton.
And by zeroing out, I believe you mean basically you're getting back as much money as you're putting in, plus that interest rate. Yeah.
Yep.
Great. Dominic, I know that you've used these quite a bit. Can you talk a little bit about GRATs from your perspective?
Yeah, I think that from a financial advisor's perspective, back to kind of some of the common reasons why people don't want to do planning is they say, I don't know if I have enough. And so this is a great point. When someone says they don't know if they have enough, it's like, well, what if you had enough today? Is that enough for you? And oftentimes, well, yeah, it's okay. Why don't we plan with the growth of your assets? So this is a great way to plan with the growth without actually giving anything of your current value away, because you're going to get that back in your annuity payments. So it's again, back to this kind of easy step in to planning. It's a great way for someone to say, oh, that, okay, I'm willing to plan with the growth because I don't have that yet. I don't know what that is. I'm willing to set up something that would be able to help improve my estate planning or move assets outside of my estate now with that growth, and be able to feel comfortable with the process before I start committing some of my corpus or my existing asset base.
That's great. Yeah, Steve talks about heads I win, tails I tie, I think, with the GRAT. Basically, it's hard to go wrong. That's great.
Right.
Okay. SLATs. Let's talk through SLATs, Stephen.
Yeah, so a spousal lifetime access trust is what we call commonly like an intentionally defective grantor trust, and these have really grown in popularity over the last like 10 to 15 years. And the reason behind that is because as the exemptions have increased exponentially over the last 5 to 10 years, there's a lot of people who are kind of hovering around that estate tax exemption amount. And they feel comfortable that they might have enough, they may not have enough to kind of give away. And so the nice thing about a SLAT is it gives you the ability to kind of have your cake and eat it too, right? So for a lot of our clients that are kind of hovering around that 12, or if you're a married couple, $25 million number, not sure they want to make a gift right now, it effectively allows you to use your exemption but maintain indirect access to the trust assets through your spouse. So when you're creating a SLAT, you're creating a trust for the benefit of your spouse and your descendants. And so you basically make a gift into that trust. And if you ever need access to those trust assets, what would happen is your spouse, who's a beneficiary of that trust, will receive a distribution from the trust. And so for a lot of clients, it gives them this sense of security, right? Of certainty that, sure, I parted with some of my assets, but if a rainy day ever comes, the markets crash like 2008, I need access to those assets. I need something in there. I have that access there. And so I think as we see a lot of clients, coming up on the end of, 2025, where the exemption is going to get cut in half all of a sudden. And, if I have $12 million on December 31st, 2025, and I didn't make a gift, all of a sudden now I didn't have a taxable estate then, but now on January 1st, 2026, I now have a taxable estate. 50% of my estate's now going to be taxable. My beneficiaries are going to pay, a couple $1 million in estate tax on the next day. I think these are going to be very popular, just like they were in 2012 for a lot of our clients.
My understanding is that it's pretty common for spouses to sort of give each other SLATs, although they can't be equivalent. Is that correct?
Yeah, so it's very common to kind of set up what we call a dual SLAT structure. But I think one of the things that's important to remember is there's a concept called the reciprocal trust doctrine. And so you each can't set up a trust that are mirror images of each other, or basically the service will collapse those trusts and disregard the gifts, right? And so I think from an attorney's perspective is you want to make sure that if you're thinking about creating trust for the benefit, each spouse is thinking about creating a SLAT, there's economic differences between the two trusts that are real and substantive, and there's also timing between the transactions. And so I think you really want to work with an attorney who understands those concepts, and a financial advisor also who understands those concepts and kind of can educate the client on why there's these economic differences in the trusts and why it's important to fund with different assets and at different times to make sure that you're not subject to that reciprocal trust argument from the service.
Great. And Dominic, how do you use SLATs with your clients?
Well, I think it's for all the points that Stephen just mentioned, but one of the common ones, and I'm just looking at this illustration, is that we'll see clients like, well, I would like to set up a trust for my kids. I'm going to set it up for my kids. And we say, well, why would you just limit your flexibility by just setting it up for your kids? If we take a little bit of a step further, we could add your spouse as a primary beneficiary, and your kids could still benefit from the trust the exact same way that they otherwise would, but it gives your financial plan a level of flexibility that you wouldn't have otherwise. We have clients that have set up trusts for just their kids, and they've regretted it because they don't have access to the money, and they can't plan with it the same way that they could if they would have just simply taken that extra step to add a spouse as a beneficiary. As Stephen mentioned, it does become a bit more complex from an estate planning perspective, but a decent attorney should be able to overcome that very easily. So this is a great flexible tool that already leverages a lot of the things that our clients want to do, but just adds a component in it that can help them in case that they might need to access funds or a little bit more flexibility than their plan might otherwise offer.
That's great strategic insight. Thank you. All right. Irrevocable life insurance trusts. Can you walk us through this, Stephen?
Yeah, so an ILIT or an irrevocable life insurance trust is probably the most like plain vanilla, C-suite kind of estate planning that we see. A lot of people have them from, the 2000s, some from back in the 90s. It's kind of for a lot of people, it's your intro into estate planning. And so basically the whole idea behind this is that if the trust is both the owner and the beneficiary of the insurance policy, then those proceeds are completely removed from the transfer tax system. They're not subject to estate tax. So with a lot of clients, if they have kind of a policy in their own name already, a lawyer will create an ILIT for them, and they'll make a gift of the policy to the ILIT. And then they'll also give some cash to the ILIT as well to kind of service annual premiums to the extent that those still are due. For other clients, they may just create an ILIT initially that'll go out and purchase the life insurance policy itself on the life of the settlor or the grantor of the trust. And then the client will just put in some amount of corpus to kind of service those annual insurance premiums. For a lot of clients too, you'll see that they make annual gifts to their ILIT. And the reason they're making those annual gifts is to, one, service the premiums, but two, it's because they can qualify. If you go back to our, section 1 or the earlier part of the section here, the annual exclusion gifts, if you properly structure those gifts to the ILIT, they're called crummy gifts. You can qualify for that annual exclusion each year on your gifts to the trust. And so that's what a lot of clients do, is to kind of service those annual premiums. They make a crummy gifts to the trust, depending on how many beneficiaries there are, and they don't use up any of their lifetime estate and gift tax exemption, and the trustee can turn around and make the annual premium payments on the insurance policy.
This one seems kind of like a no-brainer to me. If you've got an estate that's approaching taxability, is there any reason why you wouldn't want to do one of these?
No, these are absolute no-brainers. I think, if you have an insurance policy, and I would say even if you're in the, $2 to $5 million range now, just because you have no idea what the estate tax exemption is going to be. We know it's going to be halved starting on January 1st, 2026, probably. But you don't know if, the current Congress will be able to get through legislation that'll lower the exemption even more. I know, in past years, it's been as low as, $600,000, right? So this is just an easy way to kind of put assets into a trust, dip your toe into the advanced estate planning arena, get comfortable with the concepts for very little cost.
What's your perspective on ILITs, Dominic?
Yeah, like you said, there's really no reason not to do them. Sometimes we do see situations where an insurance policy was purchased over a short period of time and the client wasn't educated maybe by their insurance advisor as to the value of the ILITs. So being able to do it at the onset is extremely beneficial. But having that conversation about, not all insurance proceeds pass tax-free. And that's a very common misnomer, is people say, oh, insurance is tax-free. Yes, it is tax-free from an income tax perspective, but it could still be includable in your estate if you're not using an ILIT. So just again, just back to kind of that open conversation and ensuring that we're understanding how assets are titled that clients own and who the beneficiaries of those assets that pass outside of their estate plan, insurance proceeds were one of those, how they're structured.
Perfect.
Yeah, just to touch on what Dominic was saying, the reason why the ILIT proceed, the insurance proceeds are includable in your estate unless you're using an ILIT is because if you're the owner of the policy, then the service deems you to have what they call incidence of ownership over it, right? So you can control who's going to receive the assets, right? And so for anything that you control at your death about who's going to receive the assets, they're includable in your estate.
So you got to have the trust own it. That's great. Okay. Intentionally defective grantor trust. We talked a little bit about grantor trust earlier. So what is an intentionally defective grantor trust?
Yeah, so an intentionally defective grantor trust is merely what I had mentioned earlier, where the drafting attorney is putting in those special powers that you retain from an income tax perspective as the creator of the trust to make sure that you're treated as the owner for income tax purposes. And so the most common one that Dominic and I have referenced is the power of substitution. So when a lawyer is trying to create a grantor trust for a client because they are the most powerful and effective from an estate planning perspective, they're going to give the client the power of substitution typically over the trust corpus. And so the reason why an attorney like me would draft an intentionally defective grantor trust for a client is because I can leverage their exemption and I can freeze the value of their assets in the most efficient manner. And so a typical example here would be for, let's say you have a client who right now has a $50 million business, but they think their exit in 2 years is going to be worth $100 million, right? And so today is the day when you should transfer the fair market value of that business to the trust for the benefit of your descendants. And so what they'll typically do is they'll make a gift of part of the company, let's say up to $5 million, and then they'll sell the balance of the company, usually about 90% of the business to the trust in return for a promissory note. And so the nice thing here, one, is that sale is totally disregarded for income tax purposes. So there's no recognition event. You have low basis in your company stock. You're not all of a sudden having a huge income tax event because you want to do some estate planning, right? And the second added benefit is this client now has a promissory note owed to them from the trust. Now that does two things. One, it freezes the value of that company interest in the client's estate. So when the client sells the business 2 years from now for $100 million, that $100 million is not all in the client's estate. Only $45 million is in the client's estate, right? The other $50 million just passed transfer tax free to the client's beneficiaries via the trust vehicle. And number two is now this client has a $45 million note due back from the trust that they can use for living expenses, right? So there's interest payments going to be due annually from the trust to the client that they can live off of. But also more importantly, if they have big outlays down the road, the trust can make principal payments to them that they can use to kind of service their cash flow needs on a go-forward basis. So that's kind of one of the big planning with intentionally defective grantor trust is the sale to an intentionally defective grantor trust.
Do you have a perspective on IDGTs, Dominic?
Well, I mean, they're a very powerful tool, as Stephen mentioned, and what clients really like, it's back to that thing I mentioned earlier, where it's like, do I have enough right now? And in this case, this person was worth $50 million. They had $50 million worth of assets, and they said, okay, I could afford to make a $5 million gift right now. Well, that still leaves $45 million in their estate. So combining the sale gives them a $45 million note that they'll be able to live off of over the rest of their life, and all the growth being transferred outside of their estate via the trust.
Yeah, this is a real, kind of corollary to a GRAT, right? So this is a nice way to kind of, transfer appreciation on assets to the next generation. And one of the things that, people typically, from an estate planning perspective, a lawyer will say, a sale is better than a GRAT because with the sale, you can leverage your generation skipping transfer tax exemption. So you're not kind of subject to the same rules as we were talking about with a GRAT, where you can't apply your GST exemption until the end of the GRAT term. Here, you can apply your GST exemption up front. So typically when a client makes the $5 million gift, they're going to use up some of their gift tax exemption, but they're also going to apply their GST exemption to this trust. And so the trust can be for the benefit of kids and grandkids and more remote descendants. And so it's from my perspective, it's another kind of more powerful technique to use for people who want to provide for kids and grandkids and more remote descendants.
Great. So that wraps up our common irrevocable trusts, and there are, of course, more. And Dominic and Stephen, you gave some great detail into each of those, but I do know that they can get even more complex. So I think in the future we'll dive deeper on GRATs and IDGTs and ILITs and the rest. But I think this is a really terrific foundation. Thank you both very much. Again, want to remind all of you out there that there is more information on Vanilla Academy in terms of articles and classes. And you can also find more in our resource center at justvanilla.com. Thanks so much, and happy estate planning.
Thanks, Dan.
Thanks.
Thanks.